This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to this week's Money and Markets podcast. I'm Danni Hewson and we have a jam-packed episode for you, peppered with that optimism that is literally buzzing after the FTSE 100 smashed record after record and ended the month up once again, whilst Wall Street struggled against rate cut blues. Joining me to discuss the Fed's latest decision and more is Charlene Young. Hi, Charlene.
Hi, Danni. Yes, it's been quite a week and we're going to have to canter through some of the big US earnings updates from the likes of Amazon, Alphabet and Microsoft. Plus, we've got not one, but two special guests this week for you.
Yeah, Dan Coatsworth's done a very timely interview with JP Morgan Claverhouse fund manager Callum Abbot on the good and the bad of the UK stock market. And with mortgage approvals hitting an 18-month high last month, I've been chatting to David Hollingworth from L&C Mortgages about what he is seeing in the market.
Plus, a record amount was paid back last year by HMRC to people who were overtaxed after making their first pension withdrawal. And Royal Mail has stopped fining people for receiving letters with fake stamps on them, at least for now. Right, Danni, let's start with the market news and the good times that keep rolling for the FTSE 100.
Yeah, even yesterday morning, we're recording this Thursday morning, and even Wednesday morning, it was still breaking records. Now, the optimism was curbed a little bit later in the day ahead of the Fed rate decision. You're going to talk about that in a minute. But it has been a really great run of form. And looking at the month of April, the FTSE 100 ended the month up 2.4%. Notable because Wall Street had a particularly bad month. Both the Nasdaq and S&P 500 down more than 4% over the month. But of course, there is an awful lot of catching up to do because when you look at the past 12 months' performance, FTSE up 5%, its US rivals up more than 20%. The Nasdaq 29.2% up, powered, of course, by those big tech stocks, which some of them I'll talk about a bit more in a bit. But it's not just the falling value of the pound, which we spoke about last week, that has given the FTSE a boost, because it's also had some really solid performances from some of its constituents during this earnings season. And there's a couple I want to talk about briefly now. And I want to start with Next, because Next is seen really as a retail bellwether. And it has this habit of really playing down its expectations. So it was quite a shock in its last update when it was quite exuberant. It has, I think it's fair to say, returned to form with this latest earnings update, despite the fact that it did actually report full price quarter sales that were slightly ahead of expectation. But it hasn't changed its full year guidance. And it has warned investors that it does expect to see a bit of a drop-off in the second quarter because last quarter, the warm weather in May and June 2023 really gave it a boost. And, you know, it can't guarantee that we will see the same thing again. But what was also really interesting to note is that the majority of its sales increase was not down to its bricks and mortar estate, but down to online. And I think a lot of that is probably because we have seen, I'm going to talk about the weather again. I am obsessed with the weather, but we're all obsessed with the weather, right?
Absolutely.
And rain at the start of the year just kept people on their sofas. So that was where they were doing most of their ordering. I also wanted to briefly touch on Whitbread, the Premier Inn owner. A lot of headlines this week because it's cutting 1,500 UK jobs. Now, this is despite the fact that its last earnings update announced a 36% hike in annual profits. But it's where the money is being made that's really important because clearly Premier Inn is going from strength to strength. But as people are really sort of doubling down on where they're spending, its restaurant arm, which has the likes of Brewers Fayre and Beefeater, that has really struggled. In fact, some of its estate has been loss-making. So it's selling off around 200 of those branded restaurants. It's looking in just over 100 of them to actually replace those with more hotel rooms. So some of those job cuts that were mentioned might actually turn out not to happen, because they might be able to sort of move those staff to then man the hotels. But it just is really a demonstration of how investors are looking for these companies to really hone in, focus in on those bits that are making money. And, we've seen its shares down significantly, 15% year to date, ahead of the announcement. They did rise following the announcement by more than 2%. So I think investors have given that a bit of a stamp of approval. And just finally, when we're talking about UK stocks, I did want to touch on NatWest, because it has been impacted by those same headwinds that we've seen at other banks. So its profits have taken a hit, dropping by over a quarter in the early months of the year, because we've seen really competitive mortgage rates and also savings rates as well, which have bitten into the high street banks' earning. But there are a few things which have really sort of pleased investors, particularly as we are sort of heading into that period of time where the government is looking to sell off the rest of its stake and could start as soon as the summer to retail investors. So what we've seen is a £2 billion rise in customer deposits in the first quarter, and lending increased by 1.4 billion. So these are real box tickers for Paul Thwaite, who of course came in place of Alison Rose. And it just does sort of give a sort of nice green tick to the business as we head into that period of time when we are expecting retail investors to be given a bite of the pie. Charlene, Wall Street, though, looking a bit different.
Yes, and we've been talking about the weather, and over on Wall Street, it's not quite as rosy, as investors are dealing still with sticky inflation and a Fed that's not for turning as soon as most people expected. So going back to talk of expectations, back in January, the chat was all about when a rate cut would come in the US, not if. And since then, markets have shifted their expectations back further and further as inflation just proves really stubborn. So last night, as expected, the Fed voted unanimously to keep rates on hold. But it's the commentary from Chair Jerome Powell we were tuning in for. So he largely dismissed any idea of a rate rise. Some people were thinking that might be a possibility, but any hopes of a cut before the end of the year are now really fading, with him warning that rates must stay higher for longer to deal with this sticky inflation. So confidence and expectations, that word again, they've taken a knock, and that was largely reflected in the mood of the US stocks. They had endured what we'd refer to as a seesaw session.
Yeah, I mean, I also know that there's been then a lot of comment about whether or not how the Fed stance might impact the decision making of the likes of the European Central Bank and the Bank of England. And, clearly we're all just waiting for that pivot moment, and expectation, as you say, is going up and down, and it's really impacting volatility. But it's understandable that investors are just so totally focused on when those rates will be cut, because it does make a huge difference, particularly to growth stocks. And in the last week or so, we've had results out from a lot of those big tech supremos that have really dominated US markets over the last few years. So I'm going to touch on Amazon, Alphabet, and Microsoft. And I think it's fair to say that Amazon was probably the one that really captured investors' attention. I mean, you are talking about operating income up by 200%. I mean, this is a company that has done a massive amount of cost cutting. It's really focused in on the areas that are money making. So if you think about retail, margins are pretty slim, but it has really made sure that it can get stuff to people as quickly as it possibly can. It's brought in a huge marketplace, and that is where I think price conscious consumers are really now going, because they can get what they want at a price that they want, and they can have a real rummage around in Amazon's shop window. But AI, obviously, is still the name of the game, and its cloud computing sector. I mean, that has absolutely shot up, doing really well. But it was eclipsed this time by its advertising. So, advertising revenue for the first 3 months of this year up 24%. Now, that kind of growth is not something that it's going to be able to deliver again, because this has come about because of a change to its Prime membership. So now when you watch stuff on Prime, you are getting ads unless you're prepared to pay to opt out. And of course, more eyeballs on those ads means more revenue. But just in terms of its Amazon Web Services, they're expecting that to reach 100 billion in turnover this year. But in order to achieve that, when you've got such massive amounts of competition, Amazon is expecting to increase its capex. And that's something which we've seen really across the board from all of these tech heavyweights. So Microsoft, it reported 61.86 billion in revenue. That comes after it invested billions and billions into AI, and its cloud computing revenue surged by more than 20%. And it was really interesting because Satya Nadella, who of course is the Microsoft boss, was talking about Copilot. Have you used Copilot yet, Charlene?
No, I haven't.
It's very intuitive. And of course, that sort of AI bit, which helps you write your emails, it's like having an office manager sat on your shoulder in a lot of ways. And he was saying that that's had the fastest take up of any Microsoft service that they have launched. So when you are thinking about this is now the world's largest public company, stock market value of nearly 3 trillion, shares have increased by more than 30% over the past year. So investors really were watching to make sure that it was delivering, because when you've got these huge valuations, people expect there to continue to be a run of good form. And Amazon, that I was just talking about earlier, its stocks have risen by more than 60% over the past year. And Google, Alphabet, is up 40%. And let's end with that one, because it generated sales, excluding partner payouts, of 67.6 billion, again beating market expectation. But the key thing here, which really captured investor attention, was the fact that it said it is going to pay its first ever dividend. It's not a massive dividend, but it is just sort of, these tech stocks are coming of age. You know, we saw Meta going the same way. And in fact, Amazon now really the only holdout. And it was fascinating that they're not being pulled into this world. They want to continue in the vein of these growth companies of old and just keep putting the money back into the company. But we've got Alphabet wanting to give something back to shareholders, even if it's just a little bit. And it's just really fascinating to read some of the discussions about whether or not Amazon will be pulled into it, whether or not this is, really a mark of a stock coming of age. But we know that Google is also still striving to claw back its lead in what is a competitive market when you are talking about AI. And, when you've got the likes of Amazon and Microsoft focusing huge amounts of cash in that technical infrastructure, I think there are going to be a lot of investors wanting to make sure that this run of good form continues.
Yeah, it really does seem like a coming of age, like you say. And I think I do need to have a look at Copilot. I'll suddenly become super organized thanks to that AI tool. Just you guys wait. So sort of away from tech, we've also had some really interesting updates from some best known consumer brands too, haven't we, Danni?
We have. And I thought this was interesting because you were talking about sticky inflation in the US earlier and how that really has impacted the Fed's decision in terms of when it can cut interest rates. But it's affecting more than just the Fed. So we are seeing now the impact of that sticky inflation really making those consumers who are weary of those high prices. They've seen their disposable income sliced away, and they're making big changes about how they live. And we had some updates which really sort of showed that in stark relief from Starbucks, Yum Brands, which is the KFC owner, and McDonald's. And I want to start with Starbucks because the sales there fell for the first time since 2020 because they just aren't getting people through the doors in the same way. And if you think about the last time they fell, we were in lockdown pandemic time. So this is just a real indication of how much consumers are feeling the squeeze. I mean, do you go out for coffee anymore?
I do, but I also, in lockdown, as you say, invested in a rather swanky coffee machine here. So it's definitely a lot more of a treat now rather than a routine, like you say.
And that is exactly the issue that Starbucks is having to deal with. So particularly when you are talking now about $6 or £5 coffees, and we'll talk a bit more about that later on, you can just see why sales are really retreating and the work that it's going to have to do to try and persuade people that this is a habit that they want to get back to. And Yum Brands was in a very similar situation. So it reported a fall in quarterly global same-store sales, again, hurt by choppy demand for KFC and its Pizza Hut brands. And this is just because consumers are increasingly looking for value, or they're looking maybe just to go out once a month and not do those sort of midweek treats or, stopping off for a burger for the family or something for lunch. So, shares in Yum Brands were down as well. And that echoed the same sort of results that we saw from burger giant McDonald's. It missed profit estimates for the first time in 2 years. Now, some of that was down to particularly US consumers with lower incomes really cutting back on how much they're spending on eating out, but also, and we've spoken about this before, the boycotts that they've experienced because of the conflict over in Gaza. That has really weighed on sales there. We know McDonald's has taken steps to deal with that. It's bought back the Israeli franchise, but this is something which is going to take time in exactly the same way as just getting consumers to come back to, that kind of eating out that they used to enjoy when they had quite a bit more money in their pockets, trying to persuade them when they have a bit more money going forward, we all hope, that those kind of habits are worth getting back to.
Yeah, just had a bit of a flashback of the eat out to help out there when we're talking about going out, a rather unwelcome one 4 years on. But we did promise you 2 interviews today, so I think we need to crack on with our first one. So the UK stock market, as we know, has been rather unloved for a few years. Yet, as Danni has been talking about earlier today, there are signs that the tide could be turning and reasons for positivity. So to find out why, Dan Coatsworth recently caught up with JP Morgan Claverhouse fund manager Callum Abbot to talk about takeovers, the shrinking market, and what happens if interest rates do remain high for longer. Where is he seeing the best opportunities in the UK market? So let's hear that interview now.
So Callum, we've just seen the FTSE 100 reach a new record high. 2 FTSE 100 companies this year received takeover bids. Is this enough to get more investors interested in the UK market again? Or actually, do we need a lot more catalysts? And what might they be?
Yeah, so I think absolutely some good headlines. Always nice when the index breaks through to a new high. I think the M&A will have without doubt caught some people's eye. For us, and our perspective, of the funds we run UK only, so we don't have the overseas holdings. So we would be very interested in something that could spark a material rally in the UK equity market and get investors interested again. We think the kindling is absolutely there. So the UK is trading at sort of once in a generation discount to the MSCI world. You have to go back to sort of the mid 1970s to see the kind of bit valuation discount opportunity that you have now. And of course, that's a period when the UK went to the IMF for a bailout. And I certainly don't think economic conditions in the UK are anywhere near as bad as that. And actually, UK economy looks in pretty good shape. We've got PMIs well above 50 at the moment, which indicates economic expansion. They're better in the UK than they are in the US or in Europe. The consumer is in pretty good shape. There's real wage growth out there. The consumer confidence is gently ticking up. And post-pandemic, we've got lots of savings. So UK consumers got about 14% of GDP in savings at the moment, which is, again, well above the US and Europe. And so if that consumer can feel confident enough to start drawing down on those savings and spend them, that could be a really nice kicker for the economy. And if they invest some of it in the UK equity market, again, that could be a nice kicker for the market itself. So I think there's plenty of kindling from the UK perspective, and indeed from a global perspective as well. The global economy has dealt with this rate hike cycle remarkably well. So those international earnings that the UK equity market generates look reasonably well underpinned as well. So certainly the kindling looks good. The news headlines are supportive. But I think if there's one final catalyst that would really help, it would be an end of price insensitive selling. And so it's a phenomenon that's impacted the UK for a couple of decades now. But really, you've had huge walls of big institutional sellers. And it started with pension funds who used to own about 50% of their portfolio in UK equities and are now down to 1.6%. But more recently, we've seen some of the wealth managers as well selling a lot of UK equities as they change from a quite significant domestic bias to a more global benchmark. I think we're closer to the end of that price intensive selling than we are at the start. Clearly with pensions, there's really just not much more to sell. And I think a lot of the wealth managers have done what they wanted to do. So when that stops, and when you stop seeing huge outflows of the market, that can really get the market going again. And then of course you can start to get into virtuous circles as the market outperforms, people want to put money into it and so on and so forth, and you get a really nice virtuous circle.
I think that we've seen quite a lot of takeovers on the UK stock market. I guess in the last few years, it's been sort of smaller companies, but more recently we are seeing some larger ones. But that does imply that the market is shrinking. And certainly we're not seeing these sort of departures being offset by the same number of companies joining the market for the first time. Is there a sort of a danger we could be left with the dregs in terms of company quality on the UK stock market? And actually that makes the UK market even more unloved than it has been in recent years? Yeah,
I think it's a fair question for sure. The year to date, we've seen 10 deals with over $1 billion of market value. That compares to just 4 of that size last year. So a real ramp up in deal activity and deal size. I think the other interesting thing is we're seeing some pretty stonking premiums in some cases, and bids often getting competitive. So if you look at something like Wincanton, ended up going at 100% premium, and that reflects how cheap the starting valuation is, I think, because if a company can buy at 100% premium then and still think they can get accretion out of it, that tells you, the starting price was well off really what it should be. And I think that's true of a lot of the UK market. When we do see M&A, I think as owners of these companies, we need to be really disciplined on the price we sell at, because I look at a lot of the market and I think these should be 30-40% higher before you even consider a bid premium. So we need to be really disciplined from that perspective. And to your question on will we be left with the dregs, I don't think that's the case right now. If you look at the companies that have gone, a lot of them have been very cheap, but I wouldn't necessarily say they're always the highest quality businesses. In some cases they are very decent, but I don't think the issue is that we'll be left with the dregs. I think that the bigger issue is that if you just see constant M&A and no IPOs, you are shrinking the market. And at the same time, companies are buying their shares through share buybacks. And so again, sort of shrinking the market in some ways in that regard. So what we need, it comes back to what we talked about in the first question. We need that positive momentum to build into the UK, because if the market starts to re-rate, then we'll be in a situation where M&A for outside buyers becomes sort of potentially less attractive because the valuation isn't so beaten up and discounted. And those founders of business, those owners of businesses that want to IPO and consider the UK, will be more likely to choose the UK because they can see the valuation that they can achieve will be reasonable, and that there's some goodwill and good feeling about the market. So I think these things all relate into sort of virtuous cycles, and we're clearly have been in a bit of a negative point in the cycle for the UK equity market recently.
Well, I think obviously you've touched on some key points why there is, the UK market can be seen as attractive. Obviously, its valuation. We do get some fairly decent dividends there, and there's good diversity of industries apart from technology at sort of the upper end. But what about the negatives? I mean, is there anything that stands out with the UK where you think actually, it's right to criticise it?
Yeah, I think if you look at from a constituent perspective, it would clearly be great to have some of the mega cap tech companies that we see in other markets, and perhaps some of those large luxury names as well, which are phenomenal businesses without doubt. I think perhaps other issues might relate to things like stamp duty, where the UK is a bit of an outlier, and liquidity, which again is really a reflection, I think, of what we talked about in previous questions of the UK being a bit unloved. The other thing I think I'd love to see change in podcasts like this, and the people that are listening to it are well ahead of the game here, but is the UK becoming more of an investor society, and people becoming more interested in investing in their day-to-day lives? Because if we can get, say, people more engaged, more understanding of the benefits of investing and what that can open up for them in future life, then I think that you'll get more interest in the equity markets, you'll get more flow, more liquidity, and the market can potentially re-rate. So I think that would be a really important thing to try and develop for the country over the next few years. But clearly things like this podcast are really important in that step.
So I think lots of people have been waiting for interest rates to be cut. Expectations keep sort of getting slightly pushed back further and further, whether that's sort of in the UK or the US. But if interest rates actually stay higher for longer, or we only see very small cuts to them, is that good or bad for the UK stock market?
Yeah, it's an interesting one, because if we look back historically, the last time the UK materially outperformed European and US markets was post-tech bubble in the lead up to the GFC. And this was a period where base rates were 4%, around that sort of level. So a little bit lower than we are now, but not hugely dissimilar. So if we saw a sort of higher for longer environment, I don't necessarily think that would be bad for the UK. And a bit of inflation as well, that suits some of the commodity sectors where the UK has significant exposure. It suits the banks, which again are a big sector for the UK, and other financials as well, more broadly. So I think a higher for longer environment could be positive. And taking a step back from a purely theoretical perspective, the UK is often considered a bit of a value market. And if we think about what a higher discount rate implies for value stocks versus growth stocks, clearly the benefit or the relative benefit is for value stocks, because growth stocks have a lot of their value in long dated cash flow are yet to be generated, and so when using a high discount rate, that makes your fair value lower today. So I think as a value market, the UK is relatively well positioned if rates do stay higher for longer.
Obviously, we've got general election in the UK on the horizon at some point soon. What would a Labour government mean for the UK stock market?
Yeah, I think if we look at history, it would suggest that the party that's in charge has little impact on the performance of the equity market. And what we know of Labour so far is that under Keir Starmer, they are quite centrist in their nature. We don't yet know too many of their policies because they haven't revealed them yet. So it's quite difficult to sort of talk too specifically. But so far, they seem quite centrist, and I think that will be well received. So if we look at history and if we look at what we know so far, I don't think that a Labour government is something that we should fear at all from an equity market perspective.
And just finally, obviously, the UK market is cheap. We've talked about that. There's clearly opportunities if there's lots of takeovers going on. Where are you actually seeing the best opportunities for the portfolio that you're running?
So our biggest active holding in Claverhouse is 3i Group. It has been for quite a while now. It's been a fantastic performer. It's a private equity business that owns assets across a number of different end markets, but it's probably best known for its holding in a company called Action. Now, this is a discount retailer that's rolling out across Europe and has been phenomenally successful wherever they've launched stores. And the reason for its success is that Action focuses on the most shopped categories on the high street. So people, every time they go in there, they find something that they typically buy. And then they focus within categories only on the products that have the fastest turn, so sell the quickest. And this means they have quite a focused range in the key fast shopping categories. And because it's quite focused, they can buy in huge volume and they pass on those volume savings to their customers. And I think another stock that we've been getting increasingly interested in more recently would be NatWest Group. So last year, the UK banks had quite a tough time. I think everyone got perhaps a little bit overexcited, including management, about the benefit that higher interest rates would have for their profitability, and so they guided quite aggressively on how much profit they were going to generate, and they set too high a bar. And what happened, you saw last year, was that because they set the bar too high, expectations had to be constantly downgraded. And when you see downgrades, it's very rare for a company to outperform in the face of that, even when valuation is very compelling. But I think what we sort of started the year when we started to add to some of the UK banks, particularly NatWest Group, was that they'd reset expectations quite materially. And so when you step back from this point in time, you've got much more realistic growth, revenue and growth guidance. You've got very decent quality books of business. You know, they're not seeing provisions really, despite the rate hike cycle that we've been on. They're generating lots of capital and they're generating very high returns on their equity. And when we compare that to the valuation, we think these businesses just look way too cheap.
Dan talking to Callum Abbot from JP Morgan Claverhouse there. Right. Let's talk pensions, Charlene, and the record amount of cash repaid by HMRC last year because they've been overtaxing people taking their pensions for the first time. What's going on?
Yes, so thanks to the way that HMRC have decided to treat pension income, nearly £200 million had to be repaid to overtaxed pension savers in the last tax year. And looking at the stats, if you divide the amount reclaimed versus the number of forms in that first quarter of this year, so the last part of the tax year, a basic average was just over £3,000. But that's just the mean average. So we know there's going to be some real chunky payments having to go back there. So whilst pension reforms, pension freedoms gave people that welcome flexibility in how they can choose to take their pension when the time comes, nearly 10 years into that, people are still facing unfair tax bills and the hassle of having to reclaim it to get back in the correct position, all because of these rules. And we're talking over £1.2 billion that's been overtaxed and reclaimed since those changes to how you can take your pension in 2015. And, we've got concerns that it could even be undershooting the problem too, as people on lower incomes who are maybe less familiar with having to deal with HMRC and the tax system might actually be less likely to even go through the official reclaim process, and them having to rely on HMRC to kind of put their affairs in order for them, really quite far down the line.
So what should people do if they think that they have been overtaxed?
Yeah, so if you've set up a steady stream of income via what we call drawdown, then you shouldn't really need to take any action, as HMRC should adjust your tax code to ensure that over the course of the year you are taxed the correct amount. However, if you've made like a single withdrawal from your pot, then you'll either need to fill out one of 3 forms or rely on HMRC putting you back in the correct position at the end of the tax year. Now, obviously, we're in May and people don't want to be waiting that long. So there's 3 forms you can choose from, and which one you need to fill out just depends on whether you've accessed part of your retirement pot or whether you've emptied one of your smaller pots completely. So take a look at HMRC online if you think you've been overtaxed, and get one of those forms filled in so you can get the money back that you're owed.
It is just so complicated, isn't it? And anything to do with tax, people just feel like their brains are leaking out of their ears sometimes. And at least they have kept the helpline up, because I know a lot of people,
Well, this is something, I've talked about quite a bit. It took considerable, what we'll call ministerial pressure, I believe, to do it. But it's just, so many people being dragged into the tax system for the first time as well. And, navigating such a big change in your life when you start to take money out of those pensions that you've saved for so long. It's frankly ridiculous that they thought they could close it for the best part of a year.
Right, let's dig into the housing market now, because there's been a whole lot of news around. We've had Bank of England figures showing mortgage approvals in March hit an 18-month high, and that is despite the fact that we've seen lender after lender hike their fees. To get more of an insight into what's going on, I caught up with David Hollingworth from L&C Mortgages. David, thank you so much for joining us on the Money and Markets podcast. I think it's worth starting with, where are we at the moment with the mortgage market? Because it seems for the past, couple of years, but certainly the past few months, there's been so much volatility. And it seems that lenders pull deals almost as quickly as they put them up. Is that still the case?
It certainly can be. I mean, the volatility over the last couple of years has been pretty much unprecedented at times. Both from the mini budget, and then again we saw a big spike last summer where rates shot up again. Thankfully, they've come back quite significantly since then, but they're still bobbling around. Is the honest answer, and actually, that does just make borrowers really quite anxious around what's going to happen. Are rates coming down further? Are they going to go back up? And so it is quite hard to get a handle on exactly where things are headed, and why it's so important to focus on what's the right thing for you to do, what's going to give you peace of mind if that's your priority, or are you more focused on taking a little bit of risk maybe and hoping that interest rates are going to come back down further. But right now we are seeing another flurry of activity as lenders are pulling rates and pushing the cost of fixed rates up just a little bit and nudging them back up again. So borrowers who have been holding out in hope of better rates are suddenly having to readjust once again and finding deals coming and going very rapidly.
And what's behind that, the fact that we're seeing lenders put up those rates once again? Is that just down to the fact that the expectation of when the Bank of England might cut its rates keeps getting pushed further and further back?
Yeah, so this happens all the time. So lenders will be repricing their deals all the time, but it's just that we've seen a real flurry of activity. And that is key as to what the predictions around and the sentiment, importantly, around when base rate may start to fall. So the consensus is that base rate will come down, but what keeps shifting is when will that start and how quickly will it fall? And that feeds into lenders' funding costs directly. So this is particularly true when we're talking about fixed rates, and that's what we're seeing the volatility in at the moment. It's a much more stable platform than it was even a year or so ago. But as the expectation and data points keep coming out, so inflation wasn't dropping quite as much as the market had hoped it would, those things feed into the swap rates, and those are a good indicator of what lenders' funding costs might be. Equally, once you start getting 1, 2, 3 lenders changing their rates, that puts pressure on those deals that are already there and the sharpest looking deals. And so you get this domino effect where you actually start to see the market shift a little bit. Now, these are nudging up, This isn't a return to the kind of huge volatility that we saw a couple of years ago. It's much smaller increases, but nonetheless, they are just edging up a little bit after they dropped back so much at the beginning of this year.
So one of the most common questions that I'm asked is, I've got a fixed rate coming to an end, or I'm looking to get on the housing ladder. Should I jump now? Are rates going to come down? Is it worth going on to standard variable or a tracker or something like that? What should people do? Should they fix, or should they take that little bit of a chance that rates might come down before their 2-year fix comes to an end?
So we're seeing that most people are, when their deal ends, they're electing to fix at the moment. So we've seen tracker rates come in and out, mainly because of the flexibility that they give. So, for example, when rates shot up after the mini budget, people were using those as a holding position, because quite often you can find tracker rates which have got no lock-in period. Fixed rates tend to tie you in. However, we've seen that revert much more to fixed rates. The fixed rates on offer are much lower than tracker rates because, of course, base rate has yet to start its descent. So although the tracker margins may be of the order of 15 basis points over Bank of England base rate, the fact that the base rate hasn't come down yet means that the pay rate looks quite expensive compared with fixed rates. That's because fixed rates are pricing in the expectation of base rates start falling. So in many ways, they've already priced in some of those cuts into fixed rates. What we are seeing, though, is a shift in how people are approaching how long to lock in for. So there's a much bigger split between the medium-term 5-year deals and those who are electing to go for shorter-term deals, so 2-year fixed rate, because they're thinking, if rates do come down, I know where I stand for a couple of years, but maybe I can review it again, and hopefully interest rates will be lower at that point. No guarantees, of course, but we have definitely seen a bigger increase in 2-year take-up.
I know at the minute it would certainly be nice if we had a crystal ball and we knew exactly when rates were going to come down. But I think the one thing that everybody does seem to agree on is that era of ultra low interest rates has come to an end, at least in the medium term.
Yeah, I think we have to fix. I mean, fixed rates were available around 1% or even a touch below at one point. To be expecting a return to that level, I think most people have given up the ghost on that. So, and actually, to hold out in hope of that is not realistic at the moment. Certainly would look a long way off, and something major would have to happen. There is, of course, potential for base rate to come back down. That's what the market's expecting. But those fixed rates, as I say, are already pricing in some of those cuts. So it's really about what you do to protect against volatility. How exposed are you to volatility in rates? Because we just don't know what's going to happen. And therefore, we are still seeing people fix in. And like I say, if you're a bit more anxious about locking in at a higher rate, then maybe go for a shorter term deal. But you have to do that on the understanding that there's no guarantees that you'll necessarily get better rates further down the line. Those who are coming towards the end of their deal, what we're seeing is people still thinking about this issue much sooner. And you can start that process a lot sooner. So you could lock in a rate up to 6 months before if you want. And importantly, if you do that, whilst you've secured that rate, you doesn't stop you hopping onto a new rate if rates come down in the meantime. So one of the things that has been stumping borrowers is whether they should move now or whether they should hold on and hope that rates do edge back down.
Yeah, I mean, it is incredibly difficult decision for people to make because the difference can be hundreds of pounds. And, you know, after the couple of years that we've just had, a lot of people's budgets are already cut to the bone. But house prices have stayed resilient despite the fact that we've got these still high interest rates from the Bank of England, that it hasn't started to come down. So what are you seeing in the market at the moment?
So activity levels did obviously reduce substantially last year. Unsurprisingly, all the uncertainty around rates, the pressure of higher mortgage rates is weighing heavy on the market. But now that rates have come back down and are in a much more stable position, I think we are starting to just see activity levels tick up a little bit. So the purchase market is increasing. We've seen a lot of activity in remortgage, of course, as people look to manage their costs. But as this year progresses, I expect that we could see more activity coming back in the purchase market, particularly if we start to see interest rates drop. That will give people more confidence to make a move. First-time buyers, of course, their appetite to buy isn't reduced at all, because they've been dealing with much higher rents, which have been pushed up partly by mortgage rates. Landlords are not immune to the increases in mortgage rates. That piles of pressure onto tenants. So first-time buyers have looked really quite resilient. And in a quieter market, of course, it does give buyers the opportunity to negotiate a little bit harder, although there is still a lack of supply, which has helped prop up those prices.
Just while you're talking about first-time buyers, we've seen newspaper headlines. We've certainly heard politicians talking about potential things that they could do to help first-time buyers. There's a lot of measures floating around. Are there any that you think, actually, yeah, that potentially could work, or no, not on your life?
I think the reality is that a lot of these measures will all help certain types of person. So the two key issues first-time buyers really still are getting a substantial enough deposit together and affordability. How much can I borrow? Can I borrow enough to pay the kind of purchase prices that I need to pay for the property I want? And lenders are looking to do something about this as well. We're seeing products now, whilst there was a lot of talk around the budget that there might be a 99% mortgage, that never transpired. But actually, we have subsequently seen a lender bringing out a deal where a £5,000 deposit could secure you the mortgage, and that could be as high as 99% of the purchase price. Now, there are eligibility requirements around that, but those are the kind of solutions that could help those who have got good affordability but can't get the deposit together. It can help them get on the ladder sooner. At the same time, you've got lenders offering enhanced multiples in some cases for those that can afford it, just trying to give a bit of extra boost, or lenders looking to harness the help that family might be able to bring in. So there's a whole host of different mortgage products out there. And then you've got other things that help with the cost, like stamp duty, of course. Many first-time buyers won't have to pay stamp duty at the moment. The help with saving for a deposit with a lifetime ISA, that can be a really valuable use. And I think we may see more use of things like shared ownership. That since the demise of Help to Buy, which of course boosted the new build market and helped improve affordability for first-time buyers there, that's no longer in the running. We've seen other schemes coming in new build looking to help that sector. But things like shared ownership, where first-time buyers that can't quite reach full ownership may be able to get a stake in the property market just by buying 50%, say 25%, whatever they can afford right now.
And just in terms of people with existing mortgages who are looking to remortgage, I know there was a lot of talk, particularly in the wake of the mini budget, of things like people extending the term of their mortgage, moving on to interest-only mortgages, all of those hopefully short-term solutions. Are we still seeing a lot of that happening?
So I think some people will have used that as a way to just manage things down, the rising cost of living, and then the payment shock of coming to the end of a super low fixed rate and facing much higher rates. Will have seen some people elect to exercise those options. But as you say, hopefully short term, lots of borrowers we've seen have actually tried to see this through. They've cut back elsewhere and tried to maintain the term, because if you extend the term, even by only 5 years, say, that can add substantial amounts of interest over the life of the mortgage. So if you can manage to keep the term at its lowest level, that will help you. But again, we've seen over a number of years now, first-time buyers are increasingly taking longer terms just to give themselves some flexibility in the early years. But you can keep that under close review, and I think that's worth remembering, even if you have extended the term or you have gone on to interest only. Do keep coming back to those decisions, because you are going to have to deal with that overall interest bill. And if you can manage that back down as your situation changes, that is a really sensible thing to do.
David, thank you so much for talking to us. There's so much more that we could have spoken about. Really appreciate your time.
Thanks, Danni.
So that's David Hollingworth from L&C Mortgages there. Right, so we've just got a little bit of time to talk about Royal Mail. And did you know, Danni, that until this week, if you received a letter that had a fake stamp on it, you, the person receiving it, had to pay a fine?
I spotted this and was just amazed. And it's not a small amount either. You're talking about a £5, and although it's maybe not enough to buy you a cup of coffee in a number of high street emporiums anymore because the cost of coffee shot through the roof, it is still a lot of money.
Yeah, so after some pressure from MPs again, Royal Mail's decided kindly to suspend that fine, albeit for now. So rather than paying a £5 to get your letter, if the stamp is deemed to be a fake, it'll either be delivered with one of those yellow warning stickers, or returned to the sender in the hope that they will be the ones charged for using a counterfeit stamp. So even though there's rumours of China being behind a flood of new fakes, it's worth remembering that the new barcode stamps were actually brought in to try and combat counterfeit old-style stamps. And even genuine ones aren't always being read correctly by the machines designed to scan them. So according to one senior Royal Mail executive, the machines can be overly sensitive. Got a bit of sympathy there. But whilst Royal Mail goes off and supposedly investigates what's going on and builds an add-on to its customer app to help consumers spot fakes, I've got 3 quick tips for checking your stamps. So number 1, the duller the better. So if you hold it up to the light, it shouldn't be very shiny, as apparently that indicates different paper and could be a fake. Secondly, look closely at the security ovals in the bottom left and right-hand corner. There should be one on each side. And in a first-class stamp, the number 1 Roman numeral should be inside the oval, and then your S and T of split down the middle by the outline. And number 3, the tip is, buy them from the post office itself, either in person or on their own website. And given that I hardly send letters, I spent far too long on that one. And not asking you, Danni, about something I do have an interest in, as we talked about earlier, and that is coffee.
Yes. So we spoke about Starbucks earlier, and I was discovering that the price of coffee has gone through the roof because of concerns about the harvest in Vietnam. And this means that a huge number of our coffee houses are now charging over £5 for one of these coffees. And this is before you then add all those extra bits and pieces on. I mean, you can pay quite a lot if you go the whole hog. I am not a massive coffee drinker, I have to say. I usually go for like a pot of tea, but you like your coffee.
I do, but I must confess I am, I like strong black coffee. I'm not a massive, I will have a flat white, but I'm not a massive fan of, all these syrups and all the cream floating on top. So I don't know, I don't really want to call myself a purist, but I guess I am.
We're going to have an interview on commodities next week, so do join us then.
Okay, so that's all for this episode of the pod. Next week, we've got Dan and Laura in the hot seat, and they'll be joined by Rachel Vey for Pensions Corner. We're also going to have an update on how our very own AJ Bell funds have been performing.
Don't forget to leave a review wherever you listen to this pod. And as always, you can get in touch. Email podcast@ajbell.co.uk. Thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.